Chair Gensler, you are now recognized for 5 minutes to present your oral testimony.
Good afternoon, Chairwoman Waters, Ranking Member McHenry, and members of the committee. I'm honored to appear before you today for the first time as chair of the Securities and Exchange Commission. I've been in front of this committee multiple times in multiple administrations, and I will say this, I look forward to the day where we can meet in person in your beautiful hearing room again. Thank you for inviting me to testify on January's market volatility, and I'm pleased to be here with Mike Botson and Robert Cook, who I've known for a number of years as well. I'd like to note that my views are my own, and I'm not speaking on behalf of my fellow commissioners or of the SEC staff. These events are part of a larger story about the intersection of finance and technology, which have lived in a symbiotic relationship since antiquity. And one thing that I've come to believe is that technology can bring greater access to our capital markets. Our central question is this, though. When new technologies come along and change the face of finance, as they have done for decades, how do we continue to achieve our core public policy goals? In my role, I will always be animated by thinking about working families in the SEC's three-part mission: protecting investors, promoting fair, orderly, and efficient markets, facilitating capital formation. I'm pleased to submit written testimony that goes into detail on several factors at play during January's events. I'll just highlight a few of those key issues in this opening statement. First is gamification and user experience. I agree with the members who have already said these new user experiences have facilitated a lot for investors. They've expanded access to capital, making it easier for investors to sign up, start trading, learn about investing. These apps also use a host of features that have come to be familiar in our increasingly online world, such as gamification, behavioral prompts, and predictive data analytics. Many of these features, in essence, encourage investors to trade more frequently. This could have a substantial effect on a saver's financial position. Some academic studies suggest that the more actively you trade, the lower your returns. So while they're encouraging investing, they may also be encouraging active trading. I've asked the staff to prepare a request for public comment on these issues. The SEC must remain attuned to rapidly changing technologies with an eye to freshening up our rule set where appropriate to continue to achieve our mission. If we don't address this now, the investing public, those saving for future retirement and education, may shoulder the burden later. The second topic I'd like to discuss is this area around payment for order flow. This practice brings to mind a number of questions, including whether it creates inherent conflicts of interest between the broker-dealers on the one side and their customers on the other who want to achieve, under our rules, best execution. Now, it's important to consider this, I think, in the overall context of market structure. Currently, a significant amount of retail orders are routed to a small number of wholesalers. I detail this more in the written testimony, but I think it raises questions about whether the market structure best promotes fair, orderly, and efficient markets. Evolving market technologies, along with this payment for order flow, has also led to increasing market concentration, which we've found, history and economics show, concentration can lead to fragility in markets, deter healthy competition, and limit innovation. The next issue is short selling and market transparency. And again, as outlined in the testimony, under Dodd-Frank reforms, the SEC received mandates and authorities to increase transparency in the market. So I've asked SEC staff to prepare recommendations on transparency in short selling, stock loan markets, and something called total return swaps, which was at the center of this Archegos events in March for commission consideration, and the 5 of us commissioners can take a look to see what to do next. Next, today's social media tools have far greater reach, scale, and anonymity than previous technology. This raises the possibility that wrongdoers will attempt to use their powerful forums to hype certain stocks or manipulating markets. I'm not concerned about regular investors exercising their free speech rights online. I'm more concerned whether bad actors potentially take advantage of influential platforms. Further, is the decisions by some broker-dealers to redirect customer trading raised several issues around clearance and settlement. In essence, they stopped investors from investing. And this raises questions of the market, what I'll call plumbing. Sorry to Mike Bobson if I call the infrastructure plumbing. But investors were shut out. I do believe we can lower costs and risk in our market by shortening the settlement cycle. For instance, I've asked SEC staff to put together a draft proposal for the commission on the possibility of shortening the settlement cycles. I thank you. I look forward to your questions. It's good to be back with you. And again, I look forward to doing this in person.
Oh, I can't wait till he hosts SNL.
Next, we'll go to Mr. Bobson. You are now recognized for 5 minutes to present your oral testimony.
That was our chair right there. Wow, SEC chairman.
Waters, ranking member McHenry, members of the committee. My name is Michael Botson, and I am the CEO of Depository Trust and Clearing Corporation, a holding company that operates 3 SEC-regulated clearing agencies, including National Securities Clearing Corporation, or NSCC, of which I will speak to you today. I appreciate this opportunity to speak to the committee. In my line of work, the best days are those when nothing too exciting happens. That's because DTCC is, at its heart, a risk management organization, enhancing efficiencies and reliability in the markets. On a normal day, we process about 200 million buys and sells for a value of nearly $2 trillion. Through netting, that is reduced to about 1 million securities movement and 35 billion in cash movement, creating significant efficiencies in the market. When you buy or sell a stock, it takes 2 days for the trade to be completed. This is called T+2 settlement, trade date plus 2 days. A lot could happen during those 2 days that could create a risk that the buyer or seller fails to deliver money or shares. Because of clearing, investors don't have to worry about that. Clearing protects both firms and their customers against default risk. Default risk can destabilize markets, particularly in volatile times. People are reluctant to trade if they aren't sure they will get what they agreed to. And imagine how inefficient it would be for every market participant to assess the creditworthiness of everyone else in the market. That's where DTCC comes in. We are infrastructure. You can call us plumbing. We're not insulted. We operate behind the scenes to guarantee completion of virtually all equity trades. We do not trade or take positions or bet on the direction of the market. We do not give investment advice. We do not know who the customers are behind the trades or their reasons for trading. We simply process and risk manage trades. DTCC protects against default risk by collecting margin, which is money that clearing members post as collateral. If a clearing member defaults between trade date and settlement date, DTCC uses that collateral to complete the defaulting member's trades, no matter how much prices may have changed. Margin requirements are calculated using statistical models and model-based calculations that are set forth in our rules, which must be approved by the SEC. Margin requirements increase as the risk in the member's portfolio increases. In other words, the greater the potential loss a default could produce, the greater the need for collateral. Volatility has a very large impact on margin requirements. We saw this play out during the week of January 25th. Both volumes and volatility that week were extraordinary. On January 27th, NSCC processed about 474 million transaction sizes, exceeding the pandemic-related record volume from March 2020 by more than 100 million trades. The concentration of trading in a small number of meme stocks that week was also extraordinary. Applying those statistical models and formulas, margin requirements increased substantially for firms with large volumes in these stocks. I appreciate that the committee is exploring ways to continue to improve our markets. I'd like to describe one effort that DTCC has undertaken to date, shortening the settlement cycle for equities from 2 days to 1 day. That may sound like a small thing if it's just 1 day, but cutting the settlement period in half can make a difference. We believe that shortening the settlement cycle to T+1 would enhance market resilience, reduce margin requirements, and lower costs for investors. Following a multi-year industry-wide effort, settlement was shortened in 2017 from T3 to T2, achieving margin savings estimated at 25%. DTCC estimates that the volatility component of margin requirements could potentially be reduced by 40% with a move to T1. This could save our clearing members upwards of $6 billion per day during periods of extreme volatility. While DTCC's technology can support T+1 today, Changing the industry convention is a major undertaking that will require coordinated efforts across the whole industry. Over the past year, DTCC has engaged with a cross-section of the industry to assess readiness to further shorten the settlement cycle. In February, DTCC published a white paper outlining the benefits associated with multiple changes to the settlement cycle, including a move to T1. We are working with SIFMA and ICI to accelerate this effort. Thank you again for the opportunity to testify today. I look forward to your questions.
Well, at least Gary was here, so could not hear him at all. Maxine's going to be loud.
Thank you very much, Mr. Boughton.
Thank you. Now, the DTCC is really important because that is the part of the House of Cards, DD, that Austin Tobit was talking about, how they are complicit in this mess.
Thank you, Ranking Member McHenry and members of the committee for this opportunity to testify today, together with Chair Gensler and Mr. Bodson, regarding the January market events related to trading in GameStop and certain other stocks. We commend the committee's review of these events and related investor protection concerns. FINRA's mission is to protect investors and promote market integrity. We are a not-for-profit SRO, and we support the SEC in overseeing one critical part of the securities industry, certain broker-dealers and the individuals they employ. To that end, we administer comprehensive regulatory programs, including surveillance, risk monitoring, examination, and enforcement. And we, in turn, are subject to comprehensive examination and oversight by the SEC. This committee has heard already about the events of January, including the significant price swings and trading volume in GameStop and a limited number of other stocks. In this context, some broker-dealers restricted trading in these securities on a short-term basis. This led to confusion and frustration among some investors and concerns about the fairness of the markets. The events also focused attention on the growth of popular new retail trading platforms and services, changes in investor behavior, and the influence of social media on the markets. Our markets are dynamic and continually evolving. Market participants constantly innovate new technologies, methods of communication, and investment products and services. These innovations often benefit investors, such as by providing easier access to the markets, lower costs, and a wider range of investment products and services to choose from. But they can also present new and sometimes unanticipated risks. So regulators must constantly review whether the rules governing the road need to be updated in light of new developments to better protect investors while still facilitating vibrant and innovative markets and the opportunities these create. At FINRA, we are committed to doing just that. One important resource we rely on in this process is the research of the FINRA Investor Education Foundation, including recent research on new, inexperienced investors and how they approach investing. Since the events of January, FINRA has established an internal working group that's devoting significant resources to investigating whether its broker-dealer members comply with SEC and FINRA rules. We have also issued regulatory notices reminding firms of relevant duties and responsibilities in this area. Although I cannot comment on specific firms or ongoing investigations or enforcement matters, generally speaking, we are reviewing order routing practices, the circumstances under which trading restrictions were imposed, any potential manipulative conduct, and compliance with short sale requirements, among other matters. I can assure the committee that we will take all appropriate disciplinary or other remedial action as warranted if the facts indicate a violation of SEC or FINRA rules. The upcoming SEC report on these market events will be critical in analyzing whether existing rules and standards should be updated. Many of the policy questions raised in your hearings to date involve areas in which the SEC has primary policymaking responsibility, such as market structure, payment for order flow, short sale regulation, and disclosure, the settlement cycle, enhanced broker-dealer financial responsibility requirements, and whether certain communications with retail investors constitute recommendations that should be covered by the SEC's regulation best interest. We will support the SEC in its review of these areas and then align FINRA's rules and oversight activities where necessary or appropriate. My written testimony offers some further perspectives on key topics under the SEC's jurisdiction and also describes some areas where we are considering whether updates or guidance regarding our own rules would be appropriate. For example, we intend to review short sale position reporting by broker-dealers, as well as continue our review of the effects of gamification on retail investors.
That's huge.
FINRA looks forward to working with this committee, the SEC, and our fellow regulators to review and learn from these recent market events so that we can strengthen investor protections and enhance confidence in our nation's capital markets. Thank you, and I'd be happy.
Thank you. So we're talking about short sale positions. It's right now a huge black box of exactly where are these shorts coming from. And it seems like the SEC and the FINRA guys are on our side. The DTCC guy seems like he wants T+1, might be on our side, might not be. Remember guys, we're on our way to 81,000 subscribers. Would mean a lot if you guys hop on board, because at that point I'm buying another $1,000 at GME and AMC. If you guys care, that's cool. If you guys don't, that's cool as well. Let's go.